If you're investing in yield products or income funds like QYLD, SPYD, or SVOL, you are number one, leaving money on the table, and number two, opening yourself up to insane risk. In other words, you're getting screwed. I'm gonna show you what to do instead. If you're investing in yield products or income funds, you are leaving money on the table and opening yourself up to insane risk. In other words, you're getting screwed. I'm gonna show you what to do instead. I'm Joe Brown. I'm a former stockbroker, and now I run Heresy Financial, where I help self-directed investors decrease portfolio risk and increase long-term returns. Yield products have gotten very popular these days, ranging from covered call ETFs like QYLD to hedged short volatility funds like SVOL. But these products are not doing for you what you think they are. So first, let's take a look at one of the most common income ETFs. This is QYLD. And the way funds like this one work is that they invest in the stocks in the index, and then they sell covered calls on those stocks or on the index overall in order to produce income. As you can see from this chart, since inception, this fund is down 36%. But wait, that is not the total return, because this fund produces insane dividends, and you are exactly right. And so for the remainder of this video, every time I show you a chart, I'm going to be showing you the total return chart, because yes, the share price of QYLD is down 36% since inception, but this thing right now carries almost a 13% dividend yield as a result of all of the covered calls that it sells on the positions inside the portfolio. And so to get a proper look at the performance, we are going to look at a chart that will look like this, which is the total return of that fund. And it adds in, or in other words, it accounts for all of the dividends that were paid out. So by owning this fund, QYLD, since inception, both the share price and the dividends included, you would currently be sitting up 117%. And you can see this fund started in 2014. Now you're probably looking at that and thinking, okay, well, that's absolutely fantastic. I would love to get a 13% dividend yield consistently over time. But how does this compare to just owning the underlying? Oof, not very well. Over that exact same time frame, as you can see, while QYLD only produced a total return of 117%, QQQ produced a total return of 477%, quadrupling what QYLD did. Now, it's not QYLD's fault for just using the strategy incorrectly, as we will see as the video goes on. Here we can take a look at another one. This one, it is from JPMorgan, and they have a similar strategy. Although they are more selective with choosing stocks inside the NASDAQ, they still do use derivatives to produce income. You can see since inception, which was in 2022, JEPQ has returned a total return of 31%, which includes its almost 12% dividend yield. Again, that dividend yield is produced from the dividends on the stocks inside the fund and also the derivatives that are being issued on those stocks. However, when we compare this just against the NASDAQ index itself, you can see QQQ is up 37% in that exact same time frame. Now, obviously, these returns are much closer, but it's been a lot less time since inception on this fund, which means that the longer the time goes on, the bigger that divergence in performance will get over time. Now, we're going to take a look at a bunch of different examples here, but I want to make sure that you understand I am not trying to make the point that you shouldn't try and produce income on your portfolio. I will show you how to do that. What I am saying is that using an ETF to do this for you is always the wrong move. And to prove that, let's go look at a stock that is a lot more volatile than something like just the NASDAQ, because a lot of people think, well, the NASDAQ's just not volatile enough for a strategy like this to work. You need to use a different stock that's a lot more volatile, maybe something like, I don't know, MicroStrategy. So let's take a look at this ETF, which is an ETF that specifically owns shares of MicroStrategy and then writes calls on those shares in order to produce income. And since inception, its total return, which includes the dividend yield, is sitting at just about 224%. Now, a 224% return in a little over a year is nothing to laugh at, except for if you're just owning the shares of MicroStrategy itself. Because when we compare the performance, we can see that over the exact same time frame, the shares of MicroStrategy alone have returned 344%. You're starting to see a theme here, hopefully, that these yield products sacrifice total return for what seems like monstrous consistent income. Here's another one. The symbol is TSLY, and it is an income strategy ETF on Tesla shares, where they sell covered calls on Tesla shares to produce a monstrous dividend yield of 135%. However, you can see since inception at the end of 2022, this fund has a total return of -7%. Meanwhile, over the exact same time frame, owning just the shares of Tesla outright has had a total return of 31%. So for Tesla, in this case, you gave up a positive return in exchange for a negative total return because you were collecting a high dividend income along the way that you thought was going to make up for it, but in the end, it's just never enough to make up for the loss in that total return. Now, at this point, many people are probably saying, okay, well, this strategy doesn't really work well with stocks that go up and down, but it works really well with volatility, because volatility, while it does spike, it always eventually bleeds out. And so by shorting volatility, you get to take advantage of this and collect the income along the way. So this is a chart of the volatility index. And as you can see, while it does periodically spike and sometimes spikes a lot, volatility does always eventually bleed out. Because of this, there are plenty of short volatility funds that sell volatility derivatives in order to produce income on this guaranteed outcome of volatility falling over time. This is a chart of one of these funds. The symbol is SVXY, and you can see right off the bat, this fund has had a monstrous return from inception in 2011 all the way up to a return that is over 2,000%, except look at the date, because this is not where it's at today. This was in 2017. And if we fast forward the chart just a bit, we can see this fund absolutely collapsed. This happened because it simply could not weather the storm of a severe volatility spike. Shareholders got wiped out. And if you've been around my channel for a while, you probably recognize this fund because I've told this story many times. I was one of those shareholders, and it taught me a valuable lesson about risk management and volatility. Now, many investors looked at this and thought they could fix it, thought that it would come back. And as we move forward in time, we can see that, from that drop, we can see that it did indeed start to rise again. Although zooming back out, we can see it did not rise anywhere near where it needed to be back before that initial collapse. And the problem with these is that volatility eventually spikes again. And so now if we move the chart forward to see where it's at today, it has collapsed yet again. And right about here is where I start to see comments rolling in about the other funds that looked at funds like SVXY and said, we know we can do it better. We'll short volatility, but we'll have hedges in place so that if there's ever a giant volatility spike, we'll be long volatility so we can take advantage of that. One of these funds is SVOL. And as you can see from the chart, this hasn't worked out that well because volatility spiked recently, which should have been enough to kick into gear those hedges, but wasn't enough to stop it from absolutely cratering. And if we zoom in here, you can see from top to bottom, it is down 25%, even with its 21% dividend yield. Remember, this is a total return number. Now, since inception in 2021, this fund currently, as of today, is still up, just about 11%. But for all of the investors who were riding this thing and buying it all the way up, they just all got wiped out. And you can see periodically this fund did actually dip below into negative territory from inception. And there's no telling what volatility will do from here, which means the bleeding could continue. In other words, it's not wise and it's not safe to trust funds like this. They do not work. Now, obviously, everything is down right now. This is a bear market. So far, the S&P 500 has fallen 21% from top to bottom. If you're the typical investor, you've probably gotten burned in the past by buying something you thought was buying the dip, and it just keeps on falling from there. You finally throw up your hands, throw in the white towel, you sell so that the bleeding stops, and immediately the bounce back happens and it rallies to new all-time highs. Most people after an experience like this will just say, I'm never gonna try to buy the dip again. But here's the real deal. The only thing worse than losing money on a bad investment is letting that scare you away from making a good investment in the future, because then you actually lose twice. Bear markets are rare. Do not let this one come and go without taking advantage of some of the massive sales that are happening all over the market right now. If you don't know right now how to identify which stocks you should be buying and how to identify what prices are good prices to be buying them at, then you need my bear market investing guide. I've got it linked in the description below for you. Got a crazy sale going on right now, and it's only going to be available during this bear market. So don't wait, because if you do, and the bear market ends, this thing recovers, starts going back up, by then it's too late. So make sure you take advantage of this while you still can. So the question is, why do these yield products always perform so poorly? And again, it's not just bad performance in general, it's bad performance compared to their underlying. And the reason is very simple. It's because ETFs, by law, the way to create an ETF, you have to get your strategy approved. It's in writing. You say, this is exactly what I'm going to be doing with all the money that comes in. And then you have to stick to that. So for example, and this is not exactly how these funds work, but let's say in their fund, they say, here are the rules. We are going to sell covered calls on the S&P 500 shares every single month on this day of the month. And we're going to do that at 5% above the current market price. Well, then guess what? They always have to stick to exactly that, which means if the market is falling and tanking and they have to sell a covered call 5% above the current market price, number one, they're probably not going to get much income from that, much premium, because nobody's really buying those at that time because the market's tanking. Everybody wants puts. And the other problem is, if it's just a quick little sell-off and a bounce back, now you have limited your gains. You have sold somebody else the right to buy those shares from you, and the shares pop right back up. You lose your shares and maybe lose them at a loss, all because you are forced into just using the same strategy regardless of market condition. There's no dynamic nature to be able to look at the market and say, I think I should skip selling a call this month just because the pricing isn't there, or because I would have to sell with a strike price that is lower than my cost, or taking any other factors into consideration. These funds have to abide by their exact strategy, whether the market says it's a good opportunity or not, which means it's not exactly the strategy's fault, it's the fund structure's fault, which is why all these funds across the board always underperform. But it also means that you have an advantage here, because you can play the best of both worlds. You can participate in these strategies yourself dynamically when the market presents the right opportunities to do so, and you can skip it when the market is not giving you those opportunities. Step one, you must learn a very basic level of macroeconomics and long-term market cycles, just so you have a general idea of the long-term trend of the market, so that you know, hey, am I gonna be long biased here or short biased here? Is liquidity increasing in the system right now or decreasing? Are interest rates going up or interest rates going down? Is the money supply increasing? Is the money supply decreasing? Number two, you have to learn the fundamentals, just a very basic level. Again, you don't have to be Warren Buffett here or Benjamin Graham, but you do need to have a little bit of experience being able to value companies, because that helps you figure out what to buy. That's what fundamentals do at the end of the day. Fundamentals give you an idea of what to buy. If you have a rough idea of how to value a company, you can take a look and say, nope, I'm not gonna buy this because it's super expensive right now. And we are in a downturn. We are in a bear market. We are going into a recession. We are in a contraction period. We are seeing tightening financial conditions. So I'm not gonna buy something that's expensive when everything is headed down. Or on the flip side, you find something cheap in a time when liquidity is increasing and the macro long-term cycle indicates up and to the right, then buying those cheap things during that time, that's gonna give you a good idea. But you also have to pair that with number three, which is technicals. You don't need to be a charting wizard. You don't need to stare at a screen all day, but you do have to have some idea of how to look at a chart, because that tells you when to buy. Learn the basics like support and resistance, common chart patterns, trends, and you can see how this stacks on the first two. So we have a general idea of market direction from the macro environment. Now we have some valuation skills so we can see what to buy. We have some technicals skills so that we can understand when to short or buy. Like if you stop there, you're gonna be ahead of 99.5% of investors. But if you really want to kick it into high gear, learn basic options trading. You can hedge your downside risk and you can increase your upside potential with very basic option strategies. Buying far out of the money puts many times can offer you a cost-effective tail hedge where it's not going to cost you that much money, but if the market starts to tank, then the price increase in those can more than make up for the loss that you have on the shares themselves. Buying deep in the money calls can allow you to have a dollar for dollar move in the option versus what the stock does, but you only have to put up a fraction of the money into that investment. Selling calls on shares that you own at the right time can allow you to produce income in excess of what the dividends pay with very low risk of losing the shares. Again, you combine this with things like technicals and fundamentals, and you can very often sell covered calls yourself when the right time is there and potentially even use that extra income to pay for the protective puts. And most importantly, dynamically adjust to market conditions as they come. Don't stick with a strategy just because it's what you do. We want to invest for what is actually happening, not for what we think should happen. And then you can do for yourself what these funds are supposed to do for you without taking on that unnecessary risk and giving up total return along the way. Please don't forget to pick up that bear market investing guide before the bear market is over and it's too late. Link is in the description below. As always, thank you guys so much for watching. Have a great day.